Are you ready?
Ready.
All right, let's go. Kevin here, top 100 financial advisor and best-selling author. We are here to talk about the stock market. There's a very common phrase for investors, whether you have been investing for a day or investing for 5 decades, and it is dangerous, especially in times like this. And that is buy the dip and buy low, sell high. So we need to break this down and do it through a lens of First Republic Bank. It is a bank that it's in trouble. It's in a lot of trouble because it's lost 72% in a single week, and yet my text messages, my DMs, my inbox and comments have all been lighting up. So hey, this is the time for me to jump into this stock. Should I buy this stock? Is this a good idea? And even if you were to search YouTube like I did earlier today when researching this topic, you got people on CNBC and others saying this is the time to buy into this bank. But why? So let's go ahead and break down what happened with First Republic. Why is it even down 70% in just a week? And then whether it makes sense to hop into something like this. And I'm spoiler warning, my answer is no, absolutely not. So let's go ahead and break it down. So First Republic Bank was downgraded by S&P and they were moved from regular status to junk status. What does all of that mean? So companies offer what are called bonds. For those that may not know, bonds are loans that you can invest in. Basically, let's take company A. Company A can offer a bond. You give company A $100 and they're going to pay you 1% for 5 years. After the 5 years, you have 1% every year and then they give you your $100 back. That's how a bond works on the most basic terms. Some bonds are 1 year, 5 years, 10 years, whatever, right? They come in what we call different maturities. So that's what a bond is. Now, if you are going to buy a bond or loan a company money, what do you think matters most? Who gonna pay you back, right? And those who are most likely to pay you have the highest grades. S&P stands for Standard & Poor's. They are one of the companies that rates these companies and stocks and say, look, these companies are more likely to pay you back than others. And those that have the highest grades pay the lowest because it's a risk versus reward. So let's take Apple, solid company. They got trillions of dollars. They're good, right? Apple's gonna be here for quite a while. At least we think, right? So I can get a bond from Apple. For example, it might pay me 5%. Give them the money, they're gonna pay me back 5%. They're fine. Okay, cool. They're in the highest tier status of bond ratings. They have a good grade. But there are times when companies get a junk bond rating. Anytime your name is associated with junk, it is usually a bad thing unless your name is waste management, because that's what they do. Aside from that though, there are companies that have junk bond ratings and those bonds pay more. They're also more risky because they can go out of business and you might not get any of your money back. That gets us to First Republic because S&P rated them in junk bond status. They said, look, y'all going through some issues. The entire financial sector is going through some issues. Therefore, your bonds are junk now, which means two things. Number one, the stock tanked, because if you are in junk bond status, that tells us investors, ooh, y'all are not safe. Y'all might not be here. You may not be able to pay my loan back if I am a bond holder. That's not good. The other thing too is this. If First Republic has to finance things through bonds, that's how companies grow. They will take out loans and say, hey, we'll offer these bonds, y'all give us a loan, we'll take it and we'll grow the company. Well, if they are now in junk bond status, that means they have to pay more on those loans. What else do we know? Interest rates are going up, which means the bond rates are also going to go up. So let's say our example for Apple, well, for a junk bond company, it could be 10%. And then by next week when the Fed raises rates or whenever they do, it could go from, I don't know, 10% to 15%. And it's going to make it more expensive for a company like First Republic and others. That is one of the reasons why the stock dropped close to 20% today. Now, I've given you all the context, explained everything, and laid it out to you. Why in the world would it make sense to invest in a company like this? Honestly, I can't tell you. Now, a lot of people would just say, buy low, sell high, buy the dip, the company's down, you just plow through it, continue dollar cost averaging anyway. My hesitation with that is that not every dip is worth buying, and some dips are cliffs where they just fall off into the abyss and may not ever come back. The way that I really like to do this is if it is a large ETF, exchange traded fund, like the S&P 500, it's fine to buy the dip on 500 companies at one time. It is very rare for the entire economy and stock market to fall off a cliff for an extended period of time. If you don't believe me, look at the returns from the S&P 500 from 2000 to 2022. Okay, you can't find, actually, if you go back and look, at 77% of the time, the stock market has been positive, right? You can probably count on maybe one hand, maybe two hands at this point. So 6 years that the stock market was even negative. That's it, right? So 2000, 2022, about 6 times the market was negative. That's it. That's solid, right? The odds are in your favor. However, if you're looking at a company that is not doing well, and for good reason, you are now in junk bond status, the entire financial, or at least the entire banking sector, has a lot of question marks. Is this really the time to jump into something that's falling at a clip of 72% per week? I don't think so, especially if you are somebody who is new. You don't want your first investing experience to be like, hey, I just invested in something for the very first time in my life and I lost 70% in just a matter of days. The other problem in the finance sector right now is this is a new issue that we are dealing with. We just saw SBV fail. Then we saw Signature Bank fail. That wasn't even a week ago. That was not even a week ago. So we are not seasoned in what is going to happen next, and we don't have a great base of education to say that this makes sense or this does not make sense, which makes it a gamble. And that ain't what I'm into doing. I don't know about you. I go to Vegas to eat. I don't go to gamble. I go to watch concerts and have fun. Gambling ain't on my list of stuff to do because I don't just throw money away. I definitely don't want you to throw any money away. And this is just my view from it. There's one thing, right, to say that I'm buying the dip on something that was a bystander. What I mean by that is a company, I'm just picking on Apple because it just starts with an A, but let's say Apple. They are not in the finance sector. They're not the ones that should be dropping based on what's happening in finance. They got nothing to do with this, right? But if the stock is low and you believe in that company, which is up to you to believe or not, then yeah, that makes sense. You're buying a dip. A company like Principal Financial, not in the banking sector. They're more investments and insurance. They don't have anything to do with this, but the stock is down. That might be a buying the dip opportunity. That might be a discount opportunity. But to rush into something that is clearly on fire usually does not work. And we saw this a lot over the pandemic years. And then we saw it really 2021 and parts of 2022 as well, where people piled into bankrupt stocks and companies that were going bankrupt. GameStop, after 2020, when it initially had its pop, it hadn't done well since, right? AMC, that company has been struggling financially and people keep piling into it anyway. And it has not been working out for a year and some change now. So you got to be very, very careful. Not every dip is worth buying. Some dips are cliffs, okay? I want to re-emphasize that because a lot of people just go into stuff just because it's down, assuming that it's automatically going to bounce back up and to do so in short order. That may not be the case. And you also have to remember that when something drops 50, 60, 70%, your returns have to be humongous just to break even. And y'all can do the math at home, but I think for like a 60% loss, I'm trying to do this in my head, I shouldn't be doing it, but for like a 60% loss, you might need like 150% or close to it just to break even, okay? 150% returns don't come around often, and when they do, it takes years to break even, and that's not something that you have to do when there are other companies that are fine and there are other investing options that are fine. Why jump into something that's going to take a Herculean effort just for you to make money when there's stuff that just, you know, is an easy layup, an easy dunk for you to just take right then and there. So that's my view on it. Clearly people who get airtime on bigger networks than just this YouTube channel think differently. That's on them. But for us, for people who are normal and regular, I just want to come out and just educate you on my view of what is happening in the market right now. Are regional banks, including First Republic and several others, going to rebound and become much better? They very well could be, right? I don't think banking is going to die, but it could be bumpy here in the next few weeks and next few months for all we know. So for me, I'm going to take the path of least resistance. I ain't going that way. I don't have to steer right into a minefield or the dirt road where I can just stay on a path that is a lot smoother, at least from for the foreseeable future. So yeah, index funds still work. There are some travel companies that are still doing well. There are some infrastructure stocks that are still doing well. Why don't I just go over there where things make more sense until finance figures it out? I've been saying for a while, for those who have subscribed and liked and commented, this is your opportunity to do so right now. We got away from the banks early. We thought they were going to work in 2021 and maybe very, very early 2022. We said, nah, not going to work. Let's get out. Let's go do something different. And things have been fine for the most part, right? Don't go run into a fire when you don't have to. There's sunshine and pool tables and the beach over there. Go over there, okay? So it's just the risk isn't worth the reward, in short, and it just 9 times out of 10 it just doesn't work out. So for me, that's my thought. Let me know what you think in the comments about buying the dip and about some of these banks. Do you believe in just investing in stuff that's down like that? Ain't no shade, ain't no judgment on my end, but I do want to know your thoughts in the comments below. If nothing else, just comment for the algorithm. And if you want to become a better investor and learn more, then you know where to go. Hit the button here for members only. We do deep dive breakdowns each and every week. This week, I'm going to show you a trade that I did, an options trade that I did yesterday that worked out quite well. We had a few members that asked about option trades, how they work, what are some strategies that I use, and I'll break it all down, show you the numbers, show you what I did, and then how you may want to implement it and practice it if you choose to. All right, that is it for me. I will talk to y'all later.